Adjunct Professor Moran. We're going to begin a discussion of Chapter 19, Measuring Economic Performance. So far we've laid the groundwork for our course in macroeconomics by describing some basic concepts in economics and supply and demand in our introductory unit. Now we're ready to start trying to measure economic performance. And we're going to do that with something called national income accounting. National income accounting is similar to accounting for a business. What you want to do is you want to put all like transactions that a business incurs together and then say something about the profitability of the business. So all things that the company sells will have a separate account. You put all the sales accounts together, you subtract out all the cost accounts, and you'll have profit. Well, in national income accounting, the largest statistic is gross domestic product. And what we want to do, and you can think of gross domestic product as an expense approach as well as an income approach. Looking at it as an income approach, if we subtract out everything that happens to your income before you actually get how much you can spend of that, that's the accounting we want to do. For example, if you're working and you take the number of hours you work and multiply it by your wage rate, you'll get your gross pay. But that is not equal to how much you can spend. You have to subtract all the taxes and dues and insurance fees, whatever, to get to your net pay. That's a similar thing that we're going to do, but we're going to be doing it with economic transactions. Our goal is to go from gross domestic product, which is the total income of a society, down to a statistic called disposable income, which disposable income is actually how much money you get to spend or save. And it's this spending component of disposable income that's really important to us in the GDP expense approach, because consumption is the largest component of the GDP expense approach. So national income accounting is the measurement of overall production of the economy. It's done measuring variables that make up national production. There are three goals to national income accounting, and if you don't get all economic about it, it's pretty simple. Hey, how's the economy doing compared to historic levels? What's our actual GDP number? Then you want to track the course. Are we heading up or down? Are we entering a period of growth or recession? And then, if the economy isn't where we want it, what can we do about it? There are two approaches to measuring gross domestic product. There's an expenditures approach and an income approach. If I spend $1 on something, someone else is catching that dollar as income. So it would be an expense to me if I'm spending it and an income to somebody else. So the expense approach and the income approach will be equal. We're going to start by studying gross domestic product expenses approach. And the definition of gross domestic product is the total market value of all final goods and services produced in a country in a given period of time. All right. Now, before we actually do this, go into this definition in detail, I'd like to point out that there's another statistic called gross national product, and we need to be sure we know which statistic we're referring to. So, the difference between gross domestic product and gross national product is determined by who's doing the making, citizenship, and where this production is being done. So you can make something in the US or you can make it in a foreign country. Who's making it could be a US citizen or a foreign person within the United States, for example. If an American who is making something inside the United States, it is both gross domestic product and gross national product. If it's a foreign company making a good inside the United States, it is gross domestic product. So, for example, Honda making cars in Ohio. Honda is a foreign company and they're making cars inside the United States. We're going to count that in gross domestic product. But an American company manufacturing something overseas in another country is gross national product. This would be General Motors, American company making cars in China, a foreign country. And if it's a foreign person making cars in a foreign country, that's neither gross domestic product or gross national product. So when we talk about gross domestic product, we'll be discussing everything that is made inside the United States, regardless of who's doing it, an American or a foreign company. So the definition of GDP, this definition, let's break it into pieces. It's they're final goods and services. We have to include goods only once, and some goods go through multiple stages of production, from raw material to work in progress to final goods. And we want to measure the final value of those goods, and it will avoid double counting, as we'll see. There are two methods of capturing the value of the final good. We can either measure the price it sells to the end user for, or we can do something called value added. Final market price will equal the value added approach. Here's an example of the value added approach. So let's just take an industry, say auto manufacturing, and they have to have iron ore. They have to have steel, and to get steel you need iron ore. So let's say the iron ore people, they own the land, they own everything, and so let's say they have the iron ore for $0, and they sell it to a steel company for $1. This is the value added. They took something that wasn't worth anything and sold it for $1, so they added a value of $1. Now the steel company, they buy the iron ore for $1, and they're going to sell it for $3 to the auto manufacturing company. So they've added a value of $2. They took something that was worth $1 and transformed it into something worth $3. So they've added $2. Okay, the car company is taking something that they bought for $3 and they'll sell the car to the consumer for $10. They've added a value of $7. And if you add the value added of $1, $3, and $7, you'll get the market price of $10. So when we include things in GDP, if we have a price, we can do that. And if we don't, we can take the value added at each stage of the production process. It would be wrong to add up the value, the price of something that was sold at each level, because you would be taking the sale of $1 by the iron ore company, the value sold the steel company to the auto manufacturing company $3, and then the value of the car sold to the consumer of $10, and you get a GDP of $14. You're double counting the value added at the prior steps. Later steps of production have to bump their price for the cost of the goods they bought, in addition to the value that they add at that level of production. So to include in GDP, you can include either the final market value price or the value added. Now, there are certain things that we are not going to include in GDP. We can exclude financial transactions because no new goods and services are produced. Here are 3 examples of financial transactions that will not be included in GDP. Public transfer payments, that's when the government, for example, pays out Social Security or welfare. So a factor of production, land, labor, capital, entrepreneurship, had to earn that money, then pay it as a tax to the government, who could then dispense it to other people. You would be double counting GDP if we were going to include these as well. These money payments were included when someone earned it. So we don't want to include the public transfer payments. Similarly, private transfer payments are like gifts. And so the person who earned the income and bought the good, that will count. But you're not going to count it again when the person gives it away to somebody else. You'd again be double counting GDP. There was no increase in economic activity. You're transferring ownership of something from one person to another. Stock and bonds are also excluded. It's trading paper, and the paper represents ownership of corporations, so nothing new was included. A stockbroker fee is included, though, because he's performing a service. He's actually making the trade happen, or he's providing a recommendation. But the actual sale of the stock, the number of shares times the price per share, would not be included in GDP because it doesn't represent a good or service. Also excluded are second-hand sales. They don't represent new economic output. So you can go to stores and spend money on second-hand things like a used car or a thrift store, but those things were included in GDP the year they were produced. When they sell again, there's nothing new produced, so we are not going to include them in gross domestic product. At this point, you would want to consider completing this handout isn't included as part of gross domestic product.